The introduction of a book titled The Psychology of a Book would typically provide an overview of the book's theme and purpose. It might discuss how books influence our thoughts, emotions, and behaviors, exploring the psychology behind why we read, how we interpret stories, and the impact of literature on our minds. The introduction would likely set the stage for the chapters to come, highlighting key concepts and themes that will be explored in depth throughout the book. The psychology behind money decisions, understanding your money personality, emotions, and money management, cognitive biases in financial decision-making, building healthy money habits, investing psychology, navigating financial challenges, money and relationships, financial goal setting, and planning money mindfulness, and well-being money lessons, from behavioral economics, achieving financial resilience. The Psychology of Money by Morgan Housel delves into the intricate relationship between psychology and financial decision-making. In the chapter, The Psychology Behind Money Decisions, the book likely explores various psychological factors that influence how individuals perceive, approach, and handle money matters. This may include discussions on behavioral biases, examining common cognitive biases such as loss aversion, anchoring, and overconfidence that can lead to irrational financial decisions, emotions and money, exploring the role of emotions like fear, greed, and regret in shaping investment choices and financial behaviors, risk perception, discussing how individuals perceive and assess risks differently, impacting their willingness to take financial risks or avoid them altogether, money mindset, investigating the psychological beliefs, attitudes, and values people hold about money, wealth, and financial success, and how these beliefs influence their financial decisions. Decision-making processes, analyzing the cognitive processes involved in financial decision-making, including information processing, heuristics, and decision-making under uncertainty. In The Psychology of Money, behavioral biases refer to the tendencies or patterns of irrational decision-making that individuals exhibit when it comes to managing their finances. Here are some common behavioral biases discussed in the book. Loss aversion. This bias refers to the tendency of individuals to strongly prefer avoiding losses over acquiring gains of the same magnitude. In financial terms, it can lead people to hold on to losing investments for too long or avoid necessary risk-taking because they fear potential losses more than they value potential gains. Anchoring. Anchoring bias occurs when individuals rely too heavily on initial information, the anchor, when making decisions, even if that information is irrelevant or misleading. For example, anchoring can lead investors to place excessive importance on the price at which they bought a stock, influencing their decision to sell or hold on to it. Overconfidence. Overconfidence bias involves individuals having an overly optimistic view of their own abilities, knowledge, or predictions. In financial contexts, this can lead people to overestimate their investing skills and take on more risk than they can handle, leading to detrimental outcomes. Confirmation bias. This bias refers to the tendency to seek out information that confirms one's pre-existing beliefs or hypotheses while ignoring or downplaying contradictory evidence. In investing, confirmation bias can lead individuals to only consider information that supports their investment decisions, potentially overlooking red flags or warning signs. Herding behavior. Herding behavior occurs when individuals follow the actions or decisions of the crowd without critically evaluating the information or rationale behind those actions. In finance, this can lead to market bubbles or crashes as investors flock to popular trends or assets without fully understanding the risks involved. Recency bias. Recency bias involves giving more weight to recent events or experiences when making decisions, overlooking long-term trends or historical data. For investors, this bias can lead to chasing short-term market trends or reacting impulsively to recent market movements without considering broader market fundamentals. In The Psychology of Money, the relationship between emotions and money is a key focus area. Here are some concepts related to emotions and money that the book may cover. Fear and greed. These are two fundamental emotions that often drive financial decisions. Fear can lead to conservative behavior, such as avoiding investments or taking overly cautious approaches, while greed can result in taking excessive risks or chasing high returns without proper consideration of the associated risks. Regret avoidance. People often make financial decisions to avoid potential feelings of regret. This can manifest in actions such as holding on to losing investments for too long in the hope that they will bounce back, even when it may be more prudent to cut losses. Anxiety and stress. financial concerns can cause significant anxiety and stress for individuals, especially during periods of economic uncertainty or personal financial challenges. These emotions can influence decision-making, leading to impulsive or defensive financial choices. Happiness and satisfaction. On the positive side, achieving financial goals or experiencing financial success can bring feelings of happiness and satisfaction. However, it's important to recognize that the pursuit of wealth alone may not always lead to lasting happiness, and finding a balance between financial well-being and overall life satisfaction is crucial. Delayed gratification. Emotions like patience and self-control play a role in financial decision-making, particularly when it comes to saving, investing, and delaying immediate rewards for long-term financial security or goals. Emotional spending. The book may also explore how emotions can influence spending habits, such as impulse buying driven by emotions like excitement, boredom, or stress relief, rather than practical considerations or long-term financial planning. In the psychology of money, risk perception is a crucial concept that influences how individuals make financial decisions. Here are some key points related to risk perception that the book may cover. Subjective nature of risk. The book may discuss how risk is not an objective measure, but rather a subjective evaluation based on individual perceptions, experiences, and attitudes. What one person perceives as risky, another might see as an opportunity. Risk tolerance. This concept refers to an individual's willingness and ability to take on risk in pursuit of potential rewards. Factors such as age, financial goals, investment knowledge, and personal experiences all contribute to determining one's risk tolerance. Perception of gain and loss. People often perceive gains and losses differently, which can influence their risk-taking behavior. Loss aversion, for example, can lead individuals to be more risk-averse when facing potential losses compared to potential gains of the same magnitude. Framing and presentation. The book may discuss how the way information is framed or presented can impact risk perception. Positive framing, emphasizing potential gains, may make an investment seem less risky, while negative framing, highlighting potential losses, can increase perceived risk. Cognitive biases. Various cognitive biases, such as availability heuristic, relying on readily available information, or recency bias, placing more weight on recent events, can distort risk perception and lead to suboptimal financial decisions. Risk communication. Effective communication of risks is essential in financial contexts. The book may explore how financial institutions, advisors, and media outlets communicate risk information and how this influences investor behavior. Risk management strategies. Understanding risk perception is crucial for developing effective risk management strategies. This may include diversification, asset allocation, setting realistic expectations, and periodically reassessing risk tolerance based on changing circumstances. In the psychology of money, the concept of money mindset refers to an individual's beliefs, attitudes, and values related to money and wealth. Here are some key points related to money mindset that the book may cover. Scarcity versus abundance mindset. The book may discuss the difference between a scarcity mindset, where one views money as limited and fears lack, and an abundance mindset, where one believes in opportunities for growth and prosperity. These mindsets can significantly impact financial behaviors and outcomes. Money scripts. Money scripts are subconscious beliefs about money that influence our financial decisions and behaviors. The book may explore common money scripts such as money is the root of all evil or more money equals more happiness, and how they shape our relationship with money. Financial self-image. The book may delve into how individuals' self-image and self-worth are tied to their financial status and achievements. This can lead to behaviors like overspending to maintain a certain image or reluctance to seek financial help due to fear of judgment. Mindset shifts. The psychology of money may discuss the importance of shifting from a mindset focused solely on accumulating wealth to one that prioritizes financial well-being, resilience, and values-based decision-making. This includes re-evaluating what true financial success means to an individual beyond monetary metrics. Money and happiness. The book may explore the complex relationship between money and happiness, highlighting that while financial stability is crucial for basic needs and security, beyond a certain point, additional wealth may not necessarily lead to greater happiness. Cultural and societal influences. Money mindset is also shaped by cultural and societal factors. The book may examine how societal norms, family upbringing, media influences, and peer comparisons contribute to shaping individuals' money mindsets. Changing money mindsets. The psychology of money may provide strategies and insights on how individuals can identify and challenge limiting money mindsets, cultivate a healthier relationship with money, and align their financial behaviors with their values and goals. In the psychology of money, the decision-making processes related to money are a fundamental aspect of understanding how individuals navigate financial choices. Here are some key concepts related to decision-making processes that the book may cover. Rational versus behavioral decision-making. The book may explore the contrast between traditional economic models of rational decision-making based on maximizing utility and behavioral economics, which considers the influence of psychological factors on decision-making, such as biases, emotions, and heuristics. Information processing. Understanding how individuals gather, interpret, and process information related to money is essential. The book may discuss cognitive processes like attention, memory, and reasoning that shape how we make financial decisions. Heuristics and biases. The book is likely to delve into various cognitive biases and heuristics that influence financial decision-making, such as anchoring, availability heuristic, confirmation bias, and framing effects. These biases can lead to suboptimal decisions if not recognized and managed. Prospect theory. Prospect theory, developed by Kahneman and Tversky, is a central concept in behavioral economics that describes how individuals make decisions under uncertainty. The book may discuss prospect theory's concepts of loss aversion, diminishing sensitivity to gains and losses, and reference points in financial decision-making. Risk assessment. The book may cover how individuals assess and perceive risks associated with financial decisions, including their risk tolerance, risk perception, and attitudes toward uncertainty. Factors like past experiences, emotions, and cognitive biases can influence risk assessment. Emotions in decision-making. Emotions play a significant role in financial decision-making. The book may explore how emotions like fear, greed, regret, and overconfidence impact decision-making processes and the importance of emotional intelligence in making sound financial choices. Decision-making strategies. The psychology of money may provide insights into decision-making strategies that can help individuals improve their financial decision-making, such as setting clear goals, gathering diverse perspectives, conducting thorough research, and practicing mindfulness to reduce impulsive behavior.